fix one or two things on my side. But other than that, I am ready. So today, I want to welcome everyone who's joining us. Some of you will join us later. We see your views, we see your comments, we see the numbers increasing, usually after. So clearly, a lot of people are watching after the fact, which for us is still a good thing because we are here. Because we're on this channel, we discuss tax and accounting matters. On this channel, we educate people, we tell people what it is that one needs to do when you're an entrepreneur, when you're in business, what it is that your accounting department needs to be doing, your people that are working with you. We tell people how to run a successful business, how to stay in business, how to make money. But mostly we discuss tax and accounting matters. And we discuss issues regarding compliance. And we teach you how to run your business. So I am a business coach. My name is Carol. And on this channel, I welcome those of you who are joining. And we're happy to have you here. Thank you for being a part of this broadcast. And I'd also like to encourage you to go on our channel. You will see quite a few things. You'll see some videos. Please do watch them. Please do like anything that's appealing to you. So there's shorts, there's long videos, there's a few of our live videos where we've gone live. So every Thursday, we are live at 10 a.m. We have been trying to also do a 7 p.m. live session. We're still trying to see how it's going. It's a little bit taxing for me to go live twice in one day. We'll see how it goes. Otherwise, we might just refer people to this 10 a.m. live video. So we are live at 10 and we discuss all these matters. Please subscribe as well to our channel. I'm sure you'll find it interesting. And welcome to you, Ms. Metule. Thank you for engaging and thank you for letting me know that it's you that is here. Thank you for always supporting us as well. We appreciate the support. I am just going to give it another couple of minutes for a few more people to join. I did not remind people this week. I'm hoping that those who have been watching, they will remember. I also need to set up a system in which you will get notifications. In fact, if you are subscribing, you will get a notification. But other than that, I am ready to rock. I'm ready to roll with you, those of you who are connected. So I think maybe what I'll do, I'll start by giving you just a summary of what it is that I intend to look into today. So today, I am going to initially start very generally, but I'm then going to go into the specifics of an accounting system, accounting software, the things you should be doing, what to avoid, the pitfalls, the things that you shouldn't be doing, what it is that makes you successful. Welcome, Belinda. Thank you for engaging and letting us know that you are connected. And the rest of you, I see there's at least 12 people. I think we can start. Thank you. So as I said earlier, the name is Carol. I'm a tax practitioner, professional accountant, and a corporate governance specialist. On this channel, we discuss tax and accounting matters. We have a lot of videos that you can go back on our channel and watch. Also like, you can also subscribe. So thank you for those of you that are joining us. Let's get right into it because I can see we are already 4 minutes into our session. So today, I promised those of you who may have known that we are going to talk about what I would call behind the scenes of your accounting and your business functions. What do I mean by behind the scenes? Well, you walk into a shop right now and you say, for instance, you're walking into Builder's Warehouse and maybe they give you a receipt, you've bought something, you walk away. There's something that is happening behind the scenes before you get there, when you are there, and after you leave. And most companies, most corporates, small or big, they have to use accounting software in order to run things, to run the show or to run the books. I'm going to give you my take. The most commonly used accounting software I'm in Southern Africa. I'm actually in South Africa, but most of Africa and most of Southern Africa, as well as other parts of the world, are finding sage that has been there, I mean, tried and tested for many, 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 many years. It's still working well. Now, remember, Sage has a desktop version, which allows you to have many companies on the profile, and that's what most bookkeeping firms use, accounting firms, because then they don't need to pay per client. They just pay a flat fee and have as many clients as they want. Then there's also the cloud version, Sage 50, which is the online version. That one now will limit you because it means you need to subscribe per company. So it's suitable for small companies. Any company can then subscribe and they have that version. Their software is available to them. So you can connect even on your phone, anywhere where you have network. And that's the only pitfall, is that you can't connect to Sage Online if you're not connected to the internet. So you'd have to be in a place where you are connected to the internet in order to transact. But the beauty is that anywhere in the world, once someone is invited as an accountant, or once someone has the username or password, it means you can log on and you can view your invoices, you can view your payments, you can view your management reports, you can view your VAT report, and it also has a very good connectivity with the revenue authority. In this case, SARS or any other revenue authority, you can submit your returns online. The other accounting software that I just want to tell you about today, Xero, also being aggressively advertised. It does more or less the same thing, same function. It is also a cloud-based software. It will allow you to do your invoices. It will allow you to do your financial records. It will allow you to do your VAT report. Whatever it is that you're doing, you can easily use Xero. Then, of course, there's the likes of Intuit QuickBooks and so on and so on. There's some free ones as well that don't have as many functions. But these are all bookkeeping or accounting software packages. Then we've got the payroll side, which I'm not going to go into today. So what do I mean by behind the scenes? When you walk in, the person that is serving you will have to create an invoice. They will have to also create a slip for you that you take away. Now, in a bigger complex organization to organization, if organization A wants to order goods from organization B, it starts much earlier down the chain. So they can send a purchase order. A purchase order is not a commitment, but it's you're expressing an interest in buying certain goods or services. Now, the receiving company receives the purchase order. They can then create a quote. The quote is sent to you. Once you accept the quote is then converted to an invoice. Now, most softwares, look at the ones I've mentioned earlier. I've mentioned Sage, Xero, QuickBooks. They have an ability to convert from quote to invoice in a matter of seconds. The same details, or if there's a change, the change details, the revived details, then form the invoice. So once you receive the invoice on your end, you can now decide to proceed to either pay or receive the goods first and then pay. Now, there is such a thing as internal controls. Some people may be wondering, what are internal controls? Okay, it sounds boring, I know. But internal controls are very important because they make sure that whatever is being ordered on the other side, whatever invoice is being given, has actually been authorized by someone who is at a higher level. If that is not in place, that means employees on the floor, people all over the show can just order goods that are not needed, or they can order goods that are already there, or the wrong type of goods, or they can order goods for their own personal use and put it on the company tab. So we have what we call an internal control procedure. We have a workflow procedure. We have something in place that should allow the company to know exactly what orders are being placed. what invoices are being received. Now, once the invoices are received, obviously payment has to be made. Now, what do you call an invoice that is made to a supplier that you are buying goods from? Remember that supplier, the proper name for that supplier is a creditor. A creditor is someone who you owe, someone who is supplying you with goods. And at the end of the month or at the end of the year, one needs to be able to tell where the creditor's book is sitting. In other words, in 30 days, who do we need to pay? In 60 days, who do we need to pay? And in 90. Now, that is what we call a creditor's age analysis. That simply tells you at a specific date and time, usually monthly or annually, it'll be able to tell you to say the suppliers who you have received goods or services from are amounting to so much and they are unpaid. And this is how far back they go. So the creditor's age analysis is important because that is the only way that anybody reviewing your organization, whether it's a bank, whether it's an investor, or just anybody out there, an auditor, they can be able to tell how much debt you are in as a company, how bad things are. If you have within your creditors aging numbers that are huge in your 120 days, in your 90 days, in your 60 days, that means you are not paying your creditors early. Maybe you're even violating the terms because some creditors will tell you pay us within 30 days and maybe you're taking longer than 30 days to pay. We can tell from your creditors analysis, your creditors aging, same thing. We can tell how old your suppliers' invoices are that have remained unpaid. So creditors aging or analysis is very important because then people can be able to tell the health of an organization, the cash flow, whether the company is able to pay on time or whether they're paying late. Mind you, it's not a bad idea to have a big balance sitting in, let's say, 30 days. As long as your suppliers are actually allowing you to pay over 30 days and not charging you interest, because you are saving on your cash flow by deferring or delaying payments until you actually have to make payments. So that is what we call a creditor. A creditor is someone who you owe. It's a supplier. They've supplied you goods or they've supplied you services and you have not yet paid them. If you have a clean creditors age analysis, that means you do not owe any man anything. It means you've paid them and it means that you are not owing anything out there, which is not necessarily a good thing. It means that you're paying cash upfront for whatever you're receiving and you're not even having a chance to breathe. Therefore, you're choking yourself. The opposite end is what we call debtors. And when you have your customers coming in and placing an order, they give you their purchase order, they give you the requirement, and you then produce an invoice. Now, when you have a debtor or a customer and you invoice them, obviously the payment that they make will have to be accounted for and will clear that debtor balance. So when we have what we call a debtor's aging, it's the reverse. It's telling us within 30 days who's still owing you, who owed you last month, that's the 60 days. And if you have a huge balance sitting in your 60 and 120 days, it means your clients are not paying you on time. It means your clients are delaying payment. It means you are not collecting. And it means you might even have what we call a bad debt. What is a bad debt? A bad debt is basically an amount that has been invoiced to a customer, and perhaps the customer has not paid you, or they're not going to pay you. So there's a difference between what you call a doubtful debt and a bad debt. A doubtful debt, you're simply saying, well, there's a possibility the client may not pay. A bad debt is someone who you have phoned, you've made every effort to try and get them to pay, and maybe they haven't paid you. That is what you call a bad debt. So in your debtors aging, we should have columns as well that tell us this is current. In other words, clients that we've invoiced maybe between in the last 30 days, and then maybe some that we've invoiced in 60 days still unpaid. So your aging is simply telling us what has not yet been received in your bank account, but what you have invoiced. So the goods may have already left, the service may have already been provided, but you have not been paid yet. That is what forms your debtors aging. Now, most people, when they're applying for a loan at the bank will want to see that. They will want to know how well you are collecting from your customers. They will want to know whether you're expecting to receive money from invoices within 30 days, 60 days, or whether it's even further. So the debtors aging, the creditors aging, very critical, very important. When you're borrowing, when you are putting yourself out there, make sure that you are collecting on time from your customers so that your debtors aging is not showing huge numbers ranging into the 90-day or 120-day. With your suppliers, of course, it's a risk. If I'm loaning you money and I can see that you're already owing person A, person B, person C, I'm going to be nervous because I'm going to wonder what makes this person prioritize me now when it comes to paying my loan. So this is why banks need to see creditors aging, because they need to know who's going to be paid first. So if it's SARS, for instance, in your aging analysis, let's say you're owing SARS a lot of money. Now, SARS is not typically your trade creditor because you haven't supplied them with goods, but they are still a creditor. If you're owing SARS, let's say, for instance, 500,000 or any revenue authority, they will be the first to get their money from you. So if I'm loaning you money, I'm going to be a little bit concerned because I know that the person you will pay first is SARS, or the person who will help themselves to your bank account to pay themselves is SARS. However, some companies will simply say, well, I'm not going to pay SARS first. I'm going to pay my supplier because I need to get my goods. My company needs to keep moving. Therefore, I'm paying my supplier so that I can get more goods. Remember, there's also many other suppliers that are not related to goods. For instance, if you're importing things, say from China or wherever, you might also have your clearing agent. That's a supplier, someone you need to pay. You might also have your duties. You might have your accountants, like us, who you need to pay, your insurance. So there are so many suppliers out there, some of which are not connected directly to goods or services, but they're still suppliers and they still need to be accounted for. When you do your financials at the end of the year, for those of you who are business owners and you receive financials, those of you who are accountants and you're responsible, remember, you always need to bring in the balance of your creditors, the balance of your debtors at the end of the year, so that you give an accurate representation and people can tell where the business is sitting. It would be misleading if I receive financials telling me that, oh, I've made 5 million Rand in profit, yet I actually know that I'm owing 3 million Rand to a certain person and I haven't accounted for it. It means I'm misleading the public. Whoever is reading these financials actually thinks I've made more money than I have. If I were to bring in those creditors, if I were to bring in unpaid invoices, then my profit would go down because then I would account for all of that. Remember, the whole idea is you need to have an honest look at the business. You need to know, where am I going? How much money have I made? If I've made a loss, or if my if my profit is lower this month than it was last month, then I must know why. Where am I missing it? Where am I failing to control my costs? Where am I struggling to mark up? Sometimes, if you're, say for instance, you're buying goods for resale or you're manufacturing, a lot of people do not understand that the costing of your good need to be done properly. Therefore, if I'm buying goods, for instance, I keep using that example from China. Okay, Hong Kong, let's use a different country. If I'm bringing in goods from wherever, I must account for the transport, whether they're coming by ship or by road. I must include that in my cost. I must also include the duties that I'm paying at the airport or at the border, wherever. I must also include the fees that I'm paying to the clearing agent to have the goods cleared. All of those costs need to be accounted for if you're going to then accurately be honest with yourself and say, this is what I'm able to sell and make a profit. Now, of course, not all your goods will have the same margin, or your services. You might find that it's easier to to charge more for certain items than it is for others. Why? Because maybe you've looked at the market, other people are selling that same product for so much more. So you can hike your fees, you can hike and make more for profit here than you make elsewhere. And that's why it's always good to have a wide range of goods and services. It's good to be selling not just one thing, and to be able to then have an average and be able to, in the end, make a profit. Because in some you may make a loss, in some you may make a small profit, but it all balances out. Now, I haven't left you out if you're providing services. Same thing. If you're providing a service, say you've got a transport company, you are providing logistical services, and you are taking care of the petrol for the vehicle. You have to repair the vehicle. You have to pay the driver. You have to pay toll fees and all of that, border fees, agency fees, clearing. You need to account for every single cost before you decide what you're going to charge your client. Make sure that whatever you're charging the client is over and above what it's costing you to be able to provide the service. It's the same thing. If you're in a law firm, for instance, now those guys, I mean, they've got very few expenses. Maybe just the rental for the office, and maybe staff, if you've got staff, and a little bit of computer expenses, your Wi-Fi, a bit of stationery and marketing. In a nutshell, those are most of the expenses that some of these service providers are incurring. And therefore, you know that whatever fee you're billing to your client, 80% at least of that is profit. There's very little cost attached. So depending on the line of work you're in, the business that you are in, you'll find that your margins, your profit margins, your cost margins, they differ. And remember, you need to be able to then do monthly accounts that show you in every given month, what was your margin? In every given month, what was your profit? Where did you make more profit? Why did you make less profit this month? Corrective action is necessary. We call it historical information. So you're looking back into the past and you're saying, this is how well I did last month. Now, imagine if you're not doing your management accounts, if you're just sailing along and going as you wish. It means you have no form of record to be able to help you to improve in the future. You also don't know how to budget because you've got no basis. Remember, your budget must be based on actuals. I must be able to say, because these were my expenses last month, this is more or less what I'm hoping to do as a budget for the next 12 months. Your budget must be based on something realistic, something that has actually happened. It's the same even in your personal capacity. If you suddenly have an unrealistic budget and you say, well, I intend to buy a car cash, I intend to buy furniture cash, have you looked at your income? Does it allow you to do that? Will you be left with anything after that? It's the same translated into a company. You also need to be realistic. You need to know how well you did or what you did in previous months in order to know moving forward. They say history is looking back into the past and seeing past mistakes and correcting them so that in the future you can actually do well. Now, if you are an entrepreneur or a business owner, I'm going to challenge you today. Do you have a budget? Are you actually sticking to your budget? Are you reviewing actual performance with budget? If you are working in an organization and you are accountant or administrator, then I've said it before, make sure that you have a limit or a budget in which you are allowed to operate. Now listen, there will be instances where you go beyond budget. Something new may come up, a new product that requires expenses and unforeseen expenses. Yes, of course, you may blow the budget a little bit, but you then try and make up for it in the next month. The next thing I want to discuss with you, we've talked about debtors, we've talked about creditors, we've talked about budget, which is your cash. I want to talk to you about your inventory, your stock. You need to always know how much stock you are carrying at any given time. You need to analyze your stock as well. How fast is it moving? Do you have what we call slow moving stock? Now, if you have stock that you've had in your warehouse for 2 years, you haven't sold any of it or you sold very little, please ensure that you know that is what we call slow moving stock. so that next time you don't order it. Also, you need to think of creative ways to get rid of it. What do I mean? Well, come up with a special, come up with a combo where you try and advertise, you market, and try and get people to buy that stock. You encourage them by telling them if they buy this slow moving stock, only you know slow moving, by the way, if they buy it together with something else, they get a discount. And what do I mean by that? I'm going to give you a practical example. Say you are manufacturing ice cream, or you're an ice cream business, and you've got the strawberry flavor, which hardly anyone is buying. Maybe everybody likes vanilla, which actually should be the other way around. Kids like pink. So say you've got your vanilla, which is not moving, but you've got your chocolate, you've got your strawberry, which are fast moving. If you want to try and get rid of that vanilla, you need to come up with a combo. You need a strategy, marketing strategy. Be able to say, well, if you buy 2 of your strawberry, you will get the vanilla at a discounted price. We see it all the time in shops. We see it wherever we go. It works. And what you do is you're now getting rid of that obsolete, slow-moving stock. You may not be selling it for as much as you want to sell it for, making a slightly lower profit, but at least it's moving. At least the stock is moving. Because remember, every business that has stock needs their stock to be moving as fast as possible. You need to replace that stock. Also be careful that you are selling your stock at a cost that you're able to replace it. Many people mark up, but they don't think of the fact that they will need to replace that stock at some stage. At some point, you will need to replace that stock because you can't remain with an empty warehouse. So remember that if your replacement cost is high, because of the war that's going on right now, petrol has gone up, diesel has gone up, flights have been cancelled, therefore bringing in stock is slightly more expensive, then you need to look at the replacement cost and make sure you are costing effectively. Enough about stock and about inventory. Actually, one more thing about stock that I want to tell you about. We talked about slow moving, and you also need to know which stock moves fast. You need to know which ones you need to stock up on and make sure that you don't run out. Remember, your competitor may have a better price, but they may run out. So clients will still come to you because you're consistent, because you constantly have a different, a variety of stock. You will still be the number one supplier, because in addition to having that price, you've also got other benefits. You've also got maybe, so for some people, let's go back to our ice cream example. Maybe you've also added other product lines that people who buy ice cream will also buy. For instance, frozen yogurt, or for instance, just plain yogurt, or they need to buy, cones because they're buying ice cream. So be creative in your business. Be creative even as a working person in the business. Come up with brilliant ideas. You should be able to say to your CEO, your COO, listen, this could work. This could increase sales. Because remember, the higher the sales, the more the profits, the more the money you make, but the more the tax you'll pay. However, that should not be a deterrent to you. The fact that your higher profits will mean tax should not deter you. The more you make, the more the profits, the more your balance or your residue after you've paid tax. Remember, for company tax, here in South Africa, the tax rate is fixed. It's 27%. So whether it's 27% of 1 million profit or 27% of 5 million profit, the higher the profit, the better off you'll be. One other thing I need to advise you out there. As far as stock is concerned, and as far as goods are concerned, that is primarily for those that are either buying and selling or that are in manufacturing. If you can get yourself into an arrangement where you do not need to keep stock, all you're doing is acting as an agent, and you've got someone out there who needs goods A, but you don't need to incur the cost of keeping it in stock, that's even better. There is also such a thing as consignment stock. What is consignment stock? I've got 1 minute to explain it to you. It's simply a case where you might receive stock from someone who's producing. You're not paying for it. You only pay for it when you sell. So you keep a record to say, I've been given so many tons, but I've only sold 2 tons. Therefore, I'm only paying you for the 2 tons that I've sold. The remainder is in my stock and I won't pay for it until I've sold it. Clever way of doing business. It's been such a pleasure having you with me. Thank you for joining me. I hope you found this interesting, informative. Please please be a part of our community, share this with somebody, and have a good one. And if you're connecting with us every Thursday, 10 a.m., please do connect and please share this, invite somebody. Enjoy.